In this video, we're going to discuss target operating and target net income. We'll start by discussing target operating income, the desired amount of operating income for a period. As a reminder, we'll take revenues, subtract variable costs, and we get the contribution margin. Subtract the fixed costs, and then we get operating income. The target operating income is that operating income line you are seeing on the screen, and it's basically the organization's goal. Instead of using the word goal, they use the word target. Now, a natural question then arises, and that question becomes, how many units need to be sold to achieve the target operating income for the business? We can use a variation of the calculation we came up with for break-even quantity to calculate the number of units required to achieve the target operating income. Let's do an example to demonstrate. Let selling price per unit equal $21. Variable cost per unit will equal $11. The target operating income will equal $94,500, and the fixed costs will be $10,000. Now, if we take a look back at the break-even quantity formula, the break-even quantity was equal to the fixed costs divided by the contribution margin per unit. This works because the contribution margin per unit implies the variable costs have been taken care of. There's a selling price per unit. After the variable costs have been taken care of, each unit is still contributing something to cover the fixed costs. We could use a similar idea to determine the quantity when we are trying to achieve a target operating income. The contribution margin per unit, instead of just covering fixed costs, will now cover all of the fixed costs plus the target operating income. Let's put some numbers to it and see how it works. If we take our fixed costs of $10,000, add our target operating income of $94,500, and divide that by the contribution margin per unit, 21 subtract 11 equals $10. That equals 10,450 units. We can double check our work just to make sure everything is correct, and we'll keep track of the number of units down here at the bottom of the screen. Let's calculate revenues. $21 multiplied by 10,450 units equals $219,450. Variable cost per unit of $11 multiplied by 10,450 units equals $114,950. The contribution margin then is $104,500. The fixed costs are fixed at $10,000, and the operating income will be $94,500. Looks like it worked. The target net income. This is the desired amount of the net income for a period. What is meant by net income in most management and cost accounting textbooks? We take our revenues, subtract our variable costs, and we get contribution margin. We subtract fixed costs, and we get the operating income. From that, we subtract interest expense, income taxes, and then we get net income. So the target net income would be that bottom line number. However, remember, under cost volume profit analysis, the time value of money is ignored, meaning interest expense won't really exist. This is done to simplify the calculation so they can be done pretty quickly. If you were asked to come up with a number of units to achieve a certain target net income, what would you do? You might be tempted to use the formula that we just came up with. But we can't use this, at least not right away, because this formula has target operating income in it, not target net income. But that's okay. With a little bit of math, we can actually convert net income into operating income. or we can derive operating income as long as we have some more information. If we take our net income and divide it by 1 minus the tax rate, it will equal the operating income. Let's demonstrate. Selling price per unit will equal $21. Variable cost per unit will equal $11. The target net income will equal $56,700. The fixed costs will equal $10,000, and the tax rate will equal 40%. If you want, you can pause the video and try it yourself, and then come back to the video later on. Let's plug these numbers into our formula and see if it works. The net income is $56,700. 1 minus the tax rate of 40% is equal to 60%. And then if we do the math, the operating income will equal $94,500. We can plug this in to our original formula for the quantity of units when we have target operating income. And in fact, that 94,500 might look familiar to you because that is the same number we used in our earlier example. So if we have 10,450 units, that would be our answer. But let's just do the math fully to double check to make sure it all works. So again, we'll keep track of that number of units at the bottom, and we'll calculate revenues. $21 times 10,450 units equals $219,450. The variable cost still equals $114,950. And so the contribution margin is $104,500. The fixed costs are fixed at $10,000. And that means our operating income is $94,500. Now, if we take that number, $94,500, and multiply it by 40%, you'll get income taxes of $37,800. And if we subtract this from our operating income of $94,500, we should get net income, and that will equal $56,700. It worked. So to summarize, when we are trying to get the quantity to achieve a specific target operating income, we can use this modified version of the break-even formula. The quantity is equal to the fixed costs plus the target operating income divided by the contribution margin per unit. Now, maybe you are not given target operating income. You might be given a target net income. That's okay. Take the net income, divide it by 1 minus the tax rate, and that will equal operating income, which you can then plug into the formula. I hope you found this video useful. Until next time, I will say thank you so much for watching, and may your journey be joyful.
We talking income, let me break it down. Operating on that, we running this town. Setting goals, making moves, that's the aim. Calculate your profits, it's all in the game. First up is operating, profits on the line. Before the taxes hit, it's money we find. We got fixed costs chilling, they don't ever sway. And variables moving every single day. So we start with sales, gotta hit that peak. Subtract those costs, that's the math we see. Fixed plus variable, but we take them from the sales. Now you got the income, it never fails. Target's the goal, now work it back. What sales do you need to keep on track? Cover all the costs, then you're in the clear. Hit that target, watch your profits appear. Yeah, we talking target income, let me break it down. Operating on that, we running this town. Setting goals, making moves, that's the aim. Calculate your profits, it's all in the game. Now it's time for net, the bottom line. After taxes and interest, let's make it shine. Start operating, but don't you forget, interest and taxes still gotta be met. Take your target net, add taxes in the flow, then add the interest. Now you know that's your operating income, the goal's in sight. Make those sales pop, everything's alright. Subtract your costs, variable and fixed. What you got left is the profits mixed. Set the sales target, then go hit your stride. With the net in mind, you got nothing to hide. Yo, we talking target income, let me break it down. Operating on net, we running this town. Setting goals, making moves, that's the aim. Calculate your profits. profits, it's all in the game. So whether you're chasing net or just the operating, you gotta know the math, don't keep hesitating. Set the targets clear, plan it all out right. Hit those goals and you'll shine so bright. Keep your eyes on the prize every single day. With target income goals, so pave the way. Operating or net, the hustle's all the same. Get that paper, that's how you play the game. Yo, we talking target income, let me break it down. Operating or net, we running this town. Setting goals, making moves, that's the aim. Calculate your profits, it's all in the game.